This is task 5 of sample assessment 1 for cash and financial management. Task 5 is about liquidity management and the external rules and regulations which govern cash management. In part A, we need to match the definitions with the correct meaning. So we've got 4 meanings and we will have 4 definitions as well. We've got our fiscal policy, inflation, monetary policy and quantitative easing. So the first one then, with the rate at which prices of goods and services rise. Well, that relates to inflation. So imagine if you are inflating a balloon or inflating your car tires, you're making them bigger, aren't you? And then that's giving us the hint about prices rising and getting bigger. Next, decisions taken by government to stabilise the economy. So this is a tricky one because fiscal policy, monetary policy and quantitative easing are all things that government does to stabilise the economy. So we can't really answer this yet. We need to look at the other ones first. So the next one, increasing the amount of money in circulation. So that one is a bit easier now. That's quantitative easing. So government can do this by, for example, issuing some bonds. And effectively they're borrowing from the banks. So the banks will give money to the government for those bonds, and then the government can spend that money on building hospitals and building roads, for example. And just by building a hospital, they're going to give cash to builders, and those builders will then have cash to buy materials, and all that money will flow through the economy and allow everybody to get a bit more wealthy. And of course the government will collect tax on any profits that are being made in that economic expansion. How about the fourth one, the government control of money supply within the economy? Well, that is monetary policy. So this is how the government will try to control how much cash there is in the economy. And let's be clear that quantitative easing is an example of monetary policy. But other ways they can do that is, for example, just by spending less money or spending more money on public services. So all of that is going to flow through the economy to help improve things. So now that we've got 3 of the answers, that means we can now finish the final matching. The last one is fiscal policy. And fiscal policy is where the government tries to control it through taxation. So they will have their spending plans and they need to raise money to be able to do that. And they raise money either by borrowing or by raising taxes. And so fiscal policy is about raising taxes, basically. Let's move on to part B then. So we need to identify whether the following statements are true or false. So suspicious transactions must be reported to the National Crime Agency if they exceed 85,000. Well, that's false. There is no monetary requirement or minimum for us to raise an issue with the National Crime Agency. Next, the concealment of the origins of illegally obtained money or assets is called money laundering. Yes, that's true. That's what money laundering is. Then the third statement, the Treasury function of an organisation is responsible for preparing the statutory financial statements. That's false. The Treasury function looks after cash. So either investing surplus funds or trying to arrange borrowing if necessary. The management of an organisation's cash balances are regulated by HM Revenue and Customs. Well, no, the purpose of HMRC is to collect all the taxes from people and also collect duties for customs. So that's false. Then in part C, you need to identify which 2 of the following a company must disclose under the Companies Act 2006. So what needs to be included in a set of financial statements? Well, we need to disclose donations to political parties because that's perhaps something that the shareholders want to know about. If we're putting money into political parties that perhaps the shareholders don't like very much. Policies on investment risk. So we need to disclose risks, but we don't necessarily need to disclose the policies on those. We do need to disclose the called up share capital. That needs to be in our financial statements. And then our policies on money laundering, no, that doesn't need to be disclosed. Let's have a look now at the next part where we need to do some calculations. So we have some extracts from the financial statements for the year ended 31st December. So we've got some numbers from their profit and loss and numbers from their statement of financial position. And we need to do some calculations. So hopefully you're quite comfortable with these because you've seen some of these calculations in some of your other AAT units. So we need to work out the operating profit margin, and notice it tells us that we need to state our answer to the nearest whole number. So this answer will be marked by the computer in your exam, so you need to make sure that it's in the correct format or the computer will simply give you no mark for it. So for our operating profit margin, we want to take our operating profit and show that as a percentage of our revenue. So we're trying to work out how much of our revenue is left over after spending money on our production costs, on our admin expenses and our distribution costs. So we have 1,500 and we're dividing by 6,200, and that gives us an answer of 0.2419. Now we need to be able to give our answer to the nearest whole number. So when we convert that into a percentage, that's going to be the first two digits. And we can see the digit after one is 1, and that's a small number. So we're going to round down to 24%. And then our next one, we need to work out the trade receivable, or the inventory holding period. So that's going to be our inventory. And we're going to divide by our cost of sales. So we have 370 divided by 2,600, but we want a holding period in days, so we multiply by 365. So that gives us 51.94 days. Again, we're rounding to the nearest whole number, so we can see that the number after the decimal point is a 9, so we're going to round up to 52 days. Next, we need our trade receivables collection period. So that's going to be our trade receivables, and we're going to divide by our credit sales. So we're not told in this case whether that's cash sales or credit sales, so let's just assume it's all credit sales. So we have the 1,200 receivables divided by the 6,200 revenue. And again, we want to know this as a collection period, so we're interested in the number of days, so we're going to multiply by 365. And that gives us an answer of 70.64. Again, we're rounding to the nearest whole number, so the number after the decimal point is a 6, so that's bigger than 4, isn't it? So we're going to round up overall to 71 days. And finally, we have our trade payables payment period. So we want to take our trade payables and divide by our credit purchases. Now, we're not given credit purchases in this particular question, so the nearest alternative number would be our cost of sales. So it won't give us the right number exactly, but it's going to be close enough. So we take our payables of 440 and divide by the 2,600, but remember we want a period, so we're going to multiply by 365 the number of days in the year, and that's going to give us 61.77. Remember, we're rounding up to the nearest whole number, so we've got the 7 after the decimal point, so we're going to be rounding up to 62. And then the final question asks us to work out what is our working capital cycle. So that's going to be a combination of these three. So our working capital cycle will be the 52 days of inventory we hold and the 71 days of receivables we hold, but we take off the 62 days of payables that we need to pay to people. So that means that we're having overall 61 days of working capital.